pleasure to be here, and I want to introduce you into digital asset fund regulation, and John and I will share our presentation. I may take the lighter part and tell you about basic economic and technical stuff, and John then goes into the legal details, in particular with regard to US regulation, and of course we will touch also upon the European side. Ladies and gentlemen, digital asset funds is something that has received significant attention, in particular among emerging fund managers. We have data about more than 700 of these funds or fund projects so far. That means there is apparently some interest in this field. Yet, from a legal perspective, and both John and I are lawyers, of course, it's not our job to basically further hype something that's already hyped, but maybe lift the finger and make our clients aware about the true complexities that are in these structures, and this is exactly the purpose of our entry presentation. We will deal first with basically what digital asset funds implies, and then we will speak a bit about the investor base, discuss the risk particulars, in particular coming from the crypto asset side, of course, and then we will speak primarily about US financial regulations. I will give you then a short overview on the European side, and we will end with a number of key obstacles that we identify for a mature digital asset fund market. Yeah? So the fact that we have a lot of projects means that there may be demand, but it's better that also the investors find in 10 years that they've done something good by investing in that. And this is exactly the point where lawyers come into play to ensure that long-term stability of the asset class is likely in this market. Okay, ladies and gentlemen, let me just try to pick you up how we look at investment funds. Usually, when we speak about digital asset funds, we mean a certain type of private or venture capital fund that invests somehow in blockchain-related technology models. The important part is it's not always taking a direct stake in digital assets. There are a lot of reasons why we wouldn't do that, and we will explore them in the rest of our presentation. But the important part is that we have some exposure to the tokenized industry, and there are different ways to get that, and these different ways have all different nuances, of course. Coming from that, we have to put basically you in our perspective of how an investment fund looks like. For me, an investment fund is characterized by a certain triangle structure. Yeah? We have the fund manager who runs a certain pool. The pool is nothing else than just a bag in which the assets are stored. We have usually a custodian in Europe, where I come from, and that's my slide. They're called depositories. And we have the investors. And those three parties together make a fund succeed. Yeah? The custodian makes sure that the assets remain in the fund, that they are actually there. The manager is charged with finding the good investment opportunities on behalf of investors, and of course investors give the money. The interesting thing is, when you look in the history of investment funds, we look here today a bit in the future, but in the history of investment funds, this structure has been set up 500 years ago, and it remained remarkably stable. That means so that market institutions have tested these type of triangle structure, and if I'm aware, it's everywhere in the world that we have a kind of division of labor between the manager and the custodians on behalf of investors, in a way. Yeah? So it's important that these three things, or three entities, work together to make a viable long-term perspective for the digital asset fund market. And we will see that in this type of triangle structure, we have certain issues that we need to address by legal means, but maybe also by technical means. Coming from that, the fund has a lot of other service providers around it. We have usually risk managers, specialized asset managers. We have prime brokers that provide the lending, and we have distributors that make sure that the investors like to buy it. And you see, the fund is basically a network of contracts with a lot of intermediaries, and all of these intermediaries somehow depend on this triangle that is at the center of the investment fund. Coming from there, we need to put the fund into an institutional investment chain to understand how it works, essentially. Usually, we have some beneficiary, and then comes a pension fund that funds the fund company. The asset owner can, of course, also be a family office or whoever pools money for some other type of beneficiaries, and then the money is going through the fund company, the asset manager, into the digital asset pool. Why do I tell that? The point is, if there's trouble here, then usually the trouble will eventually sift through this chain down to, for instance, the family members, the pensioners, or eventually also the family office management. I'm sitting on a board of a regulated family office. I can tell you whenever one of our investments didn't perform according to expectations, we have longer meetings. Yeah? And of course, this is something that we should consider when we go now into digital asset funds. Everyone likes the upside, but of course, asset which is not really mature also has some downsides, and those downsides must be seen with an open eye when you go into that. With that, I'll hand over quickly to John to introduce you now into the 4 stages of the AIF investment strategies that we have seen so far. John.
All right, thank you. So in 2016, our firm finally decided we would enter the crypto space. We had looked at the asset space for a while and had been very cautious about some of the concerns. We continue to be very cautious. There's a lot of potential for liability. There are a lot of moving parts. There's a culture in some cases that is innovation first, regulation second, which doesn't always match the regulatory climate that a hedge fund should be operating within. But when it came to strategies, we've seen an evolution in the type of funds that have progressed. They started out as very basic. First, Bitcoin only, and then they were index funds. So essentially, because of how difficult it was to purchase these assets, fund managers would set these up. They would hold a certain percentage of their asset base within a given token, and they were quite successful in the short term, and some of them did very well. That proceeded to the next phase, which was a long-only focus on a more diverse range of assets, looking at some of the smaller tokens, starting to look at some of the ICOs that became a bit dangerous. These ICOs were usually put in side pockets, representing no more than approximately 10 to 20% of the fund's allocation. Those ICOs for many funds have not gone well, and that model of investing ICOs through side pockets is largely diminishing. You're gonna grab that for me. Then, with the downturn, the initial downturn of Bitcoin price and the various cryptocurrencies, we started to see a number of algorithmically driven quantitative funds. Those have continued. Some of them have performed quite well. The concern there is some of these quant funds are focused in a space that has very little competition. And so they're able to take advantage of media information that is released, various signaling that were it in a broader market with larger volume would never be possible. And so, yes, they are and have been achieving returns, but it's a fairly short-term play. Income funds is a fairly recent approach. So various cryptocurrencies rely on master nodes, for example, where there's a compensation piece. There are also, on a lesser extent, bounties and airdrops and various ways that there can be an income generation. Not a lot of scalability in the latter two on bounties and airdrops, but with master nodes, it becomes a property right, and it's an interesting factor. What we're seeing now is really a resurgence of true fundamental model-driven investing into either the direct assets or more and more through venture capital investing into blockchain-based companies, various distributed ledger technology enterprises, and that's where most of the institutional investment is coming from. And so it's really bypassing the token piece altogether. In terms of the jurisdiction, I'll just cover this briefly. We've got, if there's a US only fund, they'll always be structured in Delaware with either a Delaware limited partnership or Delaware LLC. And then you've got a management company that's set up in the home jurisdiction or in Delaware. If there's an offshore piece, we'd be looking at one of the tax neutral jurisdictions. We've done a lot of these in Cayman. There's multiple reasons for going to Cayman, including some participation that can only be done through an offshore vehicle, such as the Cayman Islands. All right, and I'll speak quickly about the investor base, because this has been interesting. There's a lot of discussion about when the institutional investors are going to come to the asset space, and some people are saying, well, the institutional investors are already here. They're in Bitcoin. There are some that are in Bitcoin, and there's trouble with the custody solution. They're in infrastructure for sure, and they're in venture capital, but early on, this was an extremely self-selecting investor group, which was highly technical and very fortunate in some of their early returns. And so we saw some unfortunate trends. I spent some time traveling, speaking with various investment bankers both in the U.S. and in Switzerland, talking about how they've perceived the trading activity, and this first wave was very vulnerable to the second wave. When this first group of investors started losing money, they became very easy prey, I would say, in some of the trading methodologies that were employed by the bit more sophisticated groups that were looking at these quantitative modeling. There was, in addition to potentially legitimate trading practices, there was rampant fraud, and we've seen various news sources, government probes looking at this. But the second wave has been much more sophisticated, finance first versus tech. And then finally, we've got some beginnings of institutional investors, including universities. So I first was quoted in Business Insider in London 2 years ago, talking about how endowments are beginning to invest, and they've done that in some of our clients. And then a few months later, Yale announced that they had invested. And so it's a strategic play, and they're small, but they're coming. A lot of these investments are happening not into a individual coin, but through a fund or through typically Bitcoin. It's the one, Bitcoin or Ethereum that have some of the minimum intermediary protections. All right. I'll just speak quickly. There's a lot of growth potential with an asterisk. In spite of the small gains that have been made, a lot of the obstacles that remain are regulatory obstacles, and They're both at the custodian level, which really wouldn't be too hard to fix if you get the right players come in. The technology pieces aren't that difficult, but someone has to put their reputation on the line, and we're getting there. We've got Fidelity, and we also now have IBM working with Shuttle Holdings to have some solutions there. The real challenge that we see is the exchanges. The exchanges are so far from the regulatory standard, so much that would need to happen to become compliant with their transparency issues, their conflicts of interest, they're holding large blocks. We're hopeful. We're seeing things like Smarts technology by NASDAQ, as well as BACT, B-A-K-K-T, a affiliate of the New York Stock Exchange that are building their own, and that over time these could evolve into much more mainstream compliant groups. But I see this as years away and not months away.